Hello, my name is Moises Rodriguez, and this video I'm putting together for my students of Accounting 561, where I was late and I'm deeply apologetic. I got here a few minutes after the majority of you left. I still caught about 6 students, but I'm deeply sorry, and I don't want you to miss out on 1 week's worth of lecture. So I'm going to do the best I can to put the most important points that I want you to focus on before week 4. I certainly hope that you take the time to look at this video. When we were ending on week 2, what I started to do was talk about cost accounting, and the primary focus of our discussion towards the end of week 2 was that of what is indirect cost versus direct. And so we talked about a couple of things, and this is a very important concept, the issue of direct versus indirect, because if something is indirect, by definition, it becomes an overhead. And I was actually having a conversation with another colleague that spent 17 years working at Maquila, and we were talking about how significant overheads have become. And in the automated world of manufacturing today, overheads could reach 40% of total cost. Well, even though that's very significant, okay, when we start thinking about the service industry, I started to discuss this with my colleague, and I started to discuss the possibility that overheads or indirect costs in the service-related industry could be as high as 80%, and in some cases, almost 100%. One of the things that we started discussing at the end of week 2 was UOP, and what the direct cost is related to you as students, or more specifically as a class. And after discussing this with my colleague today, basically the consensus is it's the cost of the instructor, because the cost of the instructor is assigned by class, and therefore that's a direct cost to this particular class. The question is, what other costs are truly direct? And at first glance, and after really thinking about this, the answer is probably none. And so what is the significance of this? Well, the significance of this is a concept that we call traceability. When we have traceability, we're able to trace a particular cost directly to the cost, the ultimate cost of a product. And it's extremely important for us to know with great precision how much it's costing us to produce a certain product, because we may be underestimating the cost, or we may be overestimating the cost, in which case that would lead us to either incurring a loss on something that we're producing, or actually losing out on a potential sale if we're overestimating the cost and we could actually make a profit on something that we actually turned down. Now, let me digress a little bit back to traceability. I want to give some examples. We talked about this somewhat on week 2, but let me reiterate, and I want to give some other examples different than what we talked about in week 2. We talked about raw materials, and for any of you that have worked in any kind of production facility or warehouse or even an office, we actually need to make a purchase requisition and order the material. We go through all sorts of authorizations, but there's when the material comes in, there's a specific code that every raw material goes to. Every raw material should be assigned to a separate T account, a specific code account, let's say, so that we can actually keep track of each specific kind of material. Now, when we requisition that material for actual use in production or in a service-related industry, then that code, that account, is then credited in as a contrary entry to reducing the inventory for that raw material. We actually charge some sort of project account. Okay, and the significance of all that is that the computer keeps a traceability, in that when that inventory is removed from the inventory account, and when I say inventory, I'm talking about raw materials, it is actually placed into the cost being accumulated for a specific project. And so when we have that traceability, we can directly account for these costs going to a specific project. And that's very important in us being able to maintain full accountability as far as how much cost have we incurred with respect to a particular project. Okay, so if we go to a maquiladora or some sort of manufacturing entity, then in a maquiladora, we can have a shoulder harness using over 3,000 different types of raw materials, parts, to put together a shoulder harness. But the computer allows us to do that transfer of those 3,000 different parts into a specific project. And so therefore there's this traceability. So much of this part went to this project, so much of that part went to this project. And so again, we can have over 3,000 different parts going into shoulder harness, and there's an accountability, there's a traceability. We can go back to the records and know exactly how much of each part went into the putting together of either one shoulder harness or a group of shoulder harnesses, and that whether it's one specific shoulder harness or a group of shoulder harnesses is something that we'll discuss in just a little bit, depending on the kind of product that we're working on. Let me gravitate a little bit to direct labor. Many of you have not experienced having to account for your time in small intervals. We talked about on week 2 that lawyers and accountants have to do so. Lawyers every 6 minutes, accountants every 15 minutes. What they do though is lawyers and CPAs are working on very specific projects, and so they're required to do very detailed records and electronically typically charge their time in these small increments, so that we can trace again exactly how much time has been put or recorded or incurred into a specific project. And there again, this is for cost containment and also for determining how much it's actually costing us to perform a particular project. Now, having said that, one of the things that we can say is CPA firms and law firms are working on unique projects. I mean, even if it's a tax return, every tax return is different. All of us have a different set of circumstances. Law firms, if we're dealing with one lawsuit versus another, it could be a totally different set of circumstances. One could be a patent defense, the other one could be an injury lawsuit. So this is why we keep our cost accumulation, and that term we call cost pool. We keep very distinct and unique cost pools with respect to that kind of work that is unique in nature. Now, I want to go into a couple of examples with you so that we can try to identify what is a direct cost and an indirect cost in environments other than the manufacturing industry. And so what I like to do is talk about hospitals. Now, the first thing I ask you is, would a doctor's time and cost be a direct cost? And I want you to think about that for a second. And so the question to you is does the doctor or somebody keep very detailed records as to how much, what procedures and time and etc. is incurred by the doctor by patient? And I think the clear answer is that the doctor may just do scribble notes, or the doctor may just scribble or dictate, information, but they do so by patient. They have codes as far as specific procedures. And because there's enough money involved, okay, they'll get somebody that's an expert in identifying codes so that they can identify the different procedures and billable codes, so that every procedure that a doctor does is assigned by client and assigned by code, so that they can bill the insurance or the patient directly. And so by taking those steps and procedures, I think we can conclude that a doctor's time is a direct cost because, again, of this traceability. Now, the next thing I take you to is a nurse. Okay, a nurse is assigned to a department and is assigned to certain patients. And the question is a nurse's time a direct cost? And I want you to think about this a little bit and think about from the standpoint, certainly there's a lot of documentation that a nurse has to take, male or female. They have to take notes as to the date and time and name of the patient. They take temperature, where they took the temperature, at what time they give a patient an aspirin, and just incredibly detailed records. But I ask you, is that detailed then incorporated into the billing? Okay. In other words, can one patient be billed more than another patient depending on how much time a nurse actually spends with that patient? And while this is a difficult question, I would say that what you have to conclude is the answer is no, because the documentation is being done from a liability standpoint, okay? And there's a great deal of detail that's documented to protect the hospital from any liability, documenting all the steps that the nurse took to document that they're following the doctor's orders and so forth. But again, anyone that's been in a hospital will know that there's one patient that's constantly pushing a button to ask for the nurse, and then there's another patient that will withstand great amount of pain and not really want to bother the nurse. And the question is, does one patient get charged more than the other? And the answer is no. Okay, and I think that the reason for that is justification. Could the hospital bill one patient a premium and charge another patient a discount? And I think that would be very difficult. The issue here is that a doctor has a certain image and a certain level of acceptability as far as their billing. A doctor bills you something and we're just accustomed to accepting it. Now, a nurse, on the other hand, is just expected for you to go and attend to you every time you push that button. Do you expect to pay more? No. And would it be possible to keep the nurse's records to incorporate as part of the billing? I think the answer is yes. But the question is that practical? And I think the final result is it's not cost justifiable, because you probably could not justify that billing on a specific time and procedure basis by the nurse. And therefore, the nurse, oddly enough, becomes an indirect cost. And it's hard to think about a nurse as being an overhead, but from an accounting standpoint, that's the way it works out. And the last example I have for you is a CT scanner. Is that a direct cost or an indirect cost? So let's think about that. A lot of you people could say, well, I get charged every time that I've had a CT scan, and they take a record of how much, for example, they'll take my name, all my bio, and they'll record the exact date that I got the CT scan. So I could say, well, yeah, because they're keeping track of its use. But here's the thing. Are they actually keeping track of the actual cost incurred to give you a CT scan? Okay, and let's think about this. I want to use an analogy. Has anyone ever gone to have a tax return prepared, or anything prepared, and all of a sudden on your invoice you get charged software use? I know that at Weiner Strickler, the last CPA firm I worked for, we used to tack on $50 software. And that's because the firm was paying $15,000 a year to get the license in order for all the accountants and everybody to be able to use the tax software to do all tax returns and everything that was related. Now, then I ask you, if you're going to pay a flat $15,000, do you really know how many tax returns you're going to do? You can go based on your existing clientele, but there's always walk-ins. You could estimate that, but then that could come close. But then there's tax returns that are more difficult than others and actually take more software use. You never know how many times you're going to rerun a tax return. The point that I'm making is that when they come up with a software charge, it's just a fixed charge. That's at best an estimate that they're going to charge to people for whom they prepare a tax return to try to recover the $15,000. But again, it's just an estimate, okay? It's not an actual traced cost. Because now let me change the facts on you. If the CPA firm was paying an outsourcing firm or an outside firm to do the software to run the tax returns, okay, every time, then they would get billed specifically by return, in which case this would become a direct cost. But when they're paying carte blanche $15,000 for unlimited use, at best they can just estimate how much cost it went into preparing your tax return. Now, the issue here is that let's get back to the CT scan. And so I ask you, when a hospital pays a great amount of money for a CT scanner, do they really know how often this CT scanner is going to be used? And I think the answer is no. They may have some historical information, but at best it's a guess. And how about this? Do they really know when a newer model is going to come out and whether the existing CT scanner is no longer as good or actually is as good as the newer model? But how about the situation that a hospital may be criticized for not replacing the CT scanner with a newer one, even though it works just as good? But through propaganda, some other hospital may say, well, their equipment is outdated and it's simply an image issue. And so all of a sudden you have to swap out. So there's all sorts of factors that come into play that will eventually determine how long and to how many times you're able to use that CT scanner. So when everything is said and done, that CT scanner, the amount they're charging you, is at best an estimate. Now, where are we going with all this? The issue is that when you have indirect cost, you don't have traceability. And so at best, the way that you allocate cost by project is an estimate. And that's the focus, a great deal of focus of this course, in that if you're forced to use estimates to determine how much it's costing you for a particular product, then you want to be as accurate as possible, okay? And so week 3 is about distinguishing procedures depending on the type of product that we're producing or the service that we're rendering, that will determine how we accumulate cost and how we allocate, especially indirect costs, so that we can most accurately, within our ability, produce accurate cost results by product. And we're not overestimating on one and us underestimating from the other. Now, what I want to do at this point is gravitate to another example I like to use, and that is border steel. For those that are not familiar with border steel is an I guess a welding. They actually produce steel out there in Vado if you're on your way on I-10 West on your way to Las Cruces. And so having had worked at El Paso Electric and having recently had a student that works at El Paso Electric, the monthly bill of border steel is about $500,000. Okay. $500,000. Okay. And the question is, do they have a different meter for their welding as opposed to their administrative offices? And the answer is probably no. Could they? Yes. Could it be done fairly easily? Yes. So from that standpoint, we could more accurately determine how to split that $500,000 of electrical consumption between the administrative side and the productive side. Okay. But then let's just go to the production side. And I ask you, I want you to think about, even if we had separate metering between the administrative side and the production side, would electricity be a direct cost? And I think that the answer is no. Now let's think about this, because in order for it to be a direct cost, we need to be able to associate electrical consumption with amount of production. Okay. Now, perhaps we can determine the amount of production per day. You would hope so. Okay. You would hope so that a production facility like this has production reports daily. Okay. The question is, can you measure consumption? Okay, you might say, well, you can do so monthly. Okay, well, that's possible, but the issue here is that if you wanted to do it daily, you almost would have to do a meter reading at midnight every night, because you never know when you're going to quit at 5, when you're going to have to work overtime. Okay. The next thing is that to get a truly accurate reading, you would almost have to have a meter reading by each welder. Okay. Now, you might think that I'm going a little bit too far, but the point that I'm trying to make is that in cost accounting or any kind of accounting, you want to find out how much it's costing you per unit to produce. And obviously, when you're welding, you're probably doing different kinds of jobs. It's not the same every day. I could be wrong. But essentially what you want to get to is how much bang per buck am I getting? In other words, how much output am I getting per input? And when you're when the lawyers are basically clocking every 6 minutes and directly attributing every 6 minutes by project, then you know exactly how much effort went in to get a particular output. The same thing with CPA firms and others that have to very accurately spend their time. The question here is it really practical for Border Steel to do that? And perhaps they could take more measures. But as I see it right now, the electrical consumption of $500,000 a year is an indirect cost. And perhaps we can talk about that more when we see each other again, which I hope is soon. Now, what I want to do is talk to you about the difference between chapter 15 as opposed to chapter 16. And the basic difference is that in both cases, we want to directly trace our direct labor and raw materials to where they're being incurred. And we're also going to use probably a similar process to allocate our overheads. The main difference here is that when we talk about process costing, we're talking about what we call a homogeneous product. Okay, if you're making tortillas all day, then if you're putting up Coke bottles, Pepsi bottles, cereal of the same brand, if you're putting together cars, all Mustangs or all Thunderbirds all day long, then the product becomes the same or pretty close. And so the way that we account for our cost accumulation is different, okay? Because we have a lack of uniqueness. Now, what do I mean by uniqueness? Well, the CPA or the lawyer, I said, the lawyer is working on a patent infringement versus an antitrust or a merger and acquisition. They're all very unique. And it's not just the lawyers, the CPAs, but for example, a machine shop, one customer may want to come in to request a specific project for one thing. Another customer is going to come in and request something with totally different criteria. And so that would be a unique project. In that case, then we want to accumulate the cost by specific project. When we have a homogeneous product, then just like mass assembly plants, and maquiladora operations, what we do is we actually set up departments. And what happens there is that people work by department. You are assigned to a department, you clock in and you clock out of the same department. And that department has a specific code. And so all costs are charged by department. Your direct labor, if you work for a particular department, you're assigned that particular code. So all your labor goes into the department you work for. The raw materials, when you request raw materials, you use that code for that department. And all those raw materials that go to that department are charged to that department. Same thing with overheads. Okay. We try to find a similar methodology to assign overheads amongst departments when we have that situation. Now, if you're wondering where we are in the big scheme of things, when we do that assignment, we do that to an account called work in process, or an acronym WIP. Okay, and when we have a homogeneous product, then we're going to have a WIP or a work in process account by department. When we have a unique project, then we're going to have a work in process account by project. Okay, and so That's the biggest difference. Now, there's one other difference between the accounting in the work in process if you're accounting for your work by department as opposed to specific project. And that is that because when we're producing a similar homogeneous product, we consider it fungible. One unit of output is the same as the next unit of output. And so therefore, we take the approach that we can actually use a weighted average approach to each unit so that we can just average all the cost out. What do I mean? Let's say that you have a mass assembly plant in Detroit and you're using the paint department. Well, you take all the labor that was incurred that month, you take all the material, the paint and the sandpaper and the bondo and everything that you use. And then you allocate your overheads and you accumulate all that cost in the paint department, let's say for the month of March. Well, that's the input, but what did you get as output? And so then they take along a number of units that they were able to produce in that month. And so what they do is they take the total cost divided by the number of units to get a weighted average cost per unit. You're going to keep on hearing this term cost per unit. When we talk about unique projects, well, we don't need to do a weighting average because we're keeping the cost by project. So we should have a very good idea about how much it's costing us for each specific project. Okay, there's one more thing that differs, okay, when we talk about a homogeneous product, and that is a term called equivalent units. Let's take, for example, back the Mustang facility in Detroit, Michigan. What we're going to have, and maybe this is splitting hairs, but let's just go with the same example. Let's just say that, let's just add some detail, that there were, at the beginning of the month of March, which is the month that we're trying to get our weighted average cost per unit, there were some cars that had been sanded down and primered, but not painted. And that is our beginning inventory of work in process. Now, let me define work in process a little bit more specific. Work in process is inventory that work has begun on. So it's greater than 0 completed, but less than 100. So as long as you start on it, but don't complete it that month, okay, it stays in work in process. Okay, so in this case, let's say that by doing all the sanding and primer, that you would consider that individual Mustang as 40% complete. Let's say that we have 100 of them. So in the month of March, okay, we actually just do the painting and put the bumper and all the parts that we had taken off to do the painting, and remove all the taping and the paper and all this, and we actually buff it and all the stuff, and that was 60% of the total work. Now, the question to you is, should we count those 100 Mustangs all completed in the month of March, or should we just consider a portion of that? And this is where we bring in the concept of equivalent units. Because the prepping, the sanding, and the primer was considered 40%, then in March, we would only be considered to have produced 60 equivalent units by taking the 100 Mustangs that were completed that had been started in February, but we only did 60% of the work. So therefore, we would have 60 equivalent units that had been completed in the month of March. For February, we would have considered 100 times 40% completion. Okay, so we give credit to February for having started the prepping and primer, and then we only give credit to March for the percentage that was lacking at the end of February. Okay, and then at the end of March, let's say we have the same situation. We have, except that we have 150 cars that have been sanded and primered. So in this case, we need to take 150 times 40. Okay, and oddly enough, that turns out to be 60, and we would consider 60 equivalent units to include in the production of March. And so from the standpoint, we have three things that actually happen that we account for when dealing with homogeneous products. We consider units that have been started but not completed in a previous month. We consider units that were started and completed during the same month, and then we consider units that were only partially completed during the current month, all to come up with what we call a total equivalent units that we use to divide into the total cost that we incurred that month. And again, the reason that we do that is because it's so important to keep track of our cost per unit. Remember that we are actually trying to keep track of that at least on a monthly basis to see if we're staying on track compared to the budget as far as our cost per unit. There are certain situations that we're trying to keep track of that on by day as far as whether we're staying on track. Certainly from a productivity standpoint, engineers get production reports daily and by the hour and sometimes on real time to see if we're staying on track with our productivity standards or quotas, if you want to call them. Okay, so I know that I've talked to you about a lot, but so far what we're talking about is allocating the costs coming from direct labor. So we would have a T account from labor, and we would, as we incur the time by project, we credit the direct labor account and debit either the specific project or the department. The raw materials the same way. As we transfer these materials for use, we credit the raw materials inventory account and we debit either the specific project or the department where they're going to be used. And then the overheads, okay, the overheads are going to be allocated, okay? And so when we use the word allocated, what that means is we're going to use the best methodology to estimate how much each project or each department should be charged with the total overheads being incurred. And so this is where we're going to focus the majority of our class into what is the best way to allocate these indirect costs so that we can most accurately determine what the real cost is by product or by department so that we can eventually get an accurate cost per unit. Now, one of the things that further complicates the issue is that a lot of our indirect costs, let's talk about Border Steel, for example, $500,000 a year, $500,000 a month. When does that bill come in? Well, typically it comes in after consumption has taken place. It could take them 10, 15 days after the fact. And we're over here trying to control cost on a daily, hourly, or on a real-time basis. And so what we're faced with is that many times we have to use estimated overheads versus actual. And the way that we do this, okay, see, here's the difference. In our electronic world, as we incur labor costs, as people punch in and out, that gets automatically charged to the project or the department on a real-time basis. CPA firms, law firms are required to turn in and record their time on a daily basis. If they do not, a nasty email goes out. So direct labor and raw materials is being accrued and charged to each project on a real-time basis. As soon as you deliver material to a project or a department, okay, you have to sign off. Almost instantaneously, that is recorded. And that recording shows that cost being charged to that project. Overheads are a different story because, again, the utility bills and all the other charges are not being charged immediately or by virtue of this traceability. Okay. What happens is that we do not have time to wait for that to come along. So what we're forced to do is use budgeted information. And what happens exactly is around October, November, December towards year end, companies start developing a budget for the next year. So they estimate actual production that's going to take place the next year. They estimate all their costs. And when they do that, they find a way to estimate how much overhead is going to be charged and how. Now, this is where we gravitate into what we talk about is cost drivers, okay? And a cost driver is basically a function that very closely defines the behavior of another cost, okay? But the cost driver is an activity, okay? What could be potential cost drivers? Well, direct labor hours, machine hours, setup hours, the number of times that you do a purchase request, the number of inspections that you have, square footage, okay? These could all be cost drivers. Now, how could square footage be a cost driver? Well, if you have just offices that are used 8 hours a day, then the larger the office, okay, then the more the electricity. And so if electricity is being used consistently, but day by day, just 8 hours to light up offices, then square footage could be an accurate cost driver. Inspections, inspection fees, excuse me. Inspection fees are usually by house. So when a construction company is trying to estimate inspection fees and their houses are going to be similar in design, they can simply estimate inspection fees based on the number of houses they project to build in the forthcoming year, and so on and so forth. The key here is that traditionally, the way that we do our budgeting of overheads, we use one simple cost driver. And traditionally, that's been direct labor hours or machine hours. And that's simply to signify that some production or operations are more labor intensive, and some production for operations are more driven by automation. Okay, and so traditionally, okay, what is done in the budget is that they estimate based on an anticipated production level how much their overheads are going to be for the whole year, and they decide, is our operation labor intensive or more automated? And depending on what the result will be, they will take the total estimated overheads for production and either divide by the estimated direct labor hours to be incurred based on that anticipated level of production, or divide by the number of machine hours that are anticipated to be incurred based on the anticipated level of production. Okay, and what results is overheads divided by an anticipated activity level that results in what we call a predetermined overhead rate. Okay, whatever number that turns out to be, okay, then every time that if labor hours is the cost driver, every time there's labor incurred, then a certain amount of overhead estimated, albeit, is charged to the project. Okay, if machine hours is allocated the cost driver, then for every hour that an equipment is driven, then a certain amount of overhead is going to be allocated to that project. Now, we have to consider this estimated, but I don't know if at this point anybody can relate to a situation where they've gone to a machine shop or whatever and they said, well, we incurred this many hours of this equipment, and so this is an added charge for overheads. Okay, but anyway, that's the way we do it. And so we've got this other estimate. We've got so far two things going on. We're allocating the total overheads by project based on the best methodology that we can, and then we're using estimated numbers. Now, we usually, as far as these estimated numbers, we usually do a reconciliation on a quarterly basis. Unfortunately, from a practical standpoint, we send this variance or difference to cost of goods sold. Hopefully, production managers and accountants take these variances into account and try to tweak the way they're allocating the overheads, so that if those variances are large, then they take that into account in determining what their actual cost per unit was. And if there's tweaks that need to be done, they start incorporating them. Now, this is basically doing it, on the go. Okay, and so all we can do is make these adjustments on a go-forward basis and take these things into account as best we can. Now, I know I've talked for a long time, but we're about to enter the most difficult and the most important concept of all, okay? And that is the issue of whether traditional allocation of overheads is sufficiently accurate in our day and age. And we talk about that the more automation we get into, the higher our level our indirects, and that when we talk about the service industry, that really can get into an exorbitant amount of indirect costs compared to direct. And so the indirect costs become more material or significant. And the question is, do all costs behave in a different manner? Okay. Is the consumption of water going to behave based on the same activity level as the consumption of electricity? So I take you back to Border Steel. Is their consumption of electricity going to behave in the same manner as the consumption of water? Well, if in the manufacturing process they're using an incredible amount of electricity, but they don't really need water, then perhaps most of the water is going to be for the fountain, for the toilets, which is not really related to the production function. And so perhaps we could use machine hours or something like that as a cost driver for electricity, and then use, I don't know, square footage for water. Okay, it depends on, every case is going to be different. But the point where I'm going is that Chapter 17 is called ABC, or activity-based costing. And basically the theory here is it argues that you should segregate costs, okay, indirect costs, overhead costs, into subcategories, okay? And those subcategories should be determined according to how the cost will either increase or decrease according to activity level, okay? And for example, inspection fees. What's the activity level that drives the cost of inspection fees? Well, inspections. What drives inspections? Typically, number of houses. So we're looking for a cause and effect, okay? And so it's looking for a relationship. What activity level is basically driving your cost, okay? And so, for example, at El Paso Electric 20 years ago, it was estimated that it would cost $50 just administrative costs to process a check. So then how could we identify this cost? And so perhaps one of the things that we could do is group certain costs according to a certain activity level, maybe number of check requests, okay? Or if we wanted to identify a different group of costs, like all the costs that was incurred in getting a purchase order and ordering material, perhaps we could say number of purchase orders. If we wanted to say, how can we determine how much our material handling costs will be? All the costs of the warehouse people, the forklifts, the storing of the material, and the delivery of the material to the production floor. Perhaps we could say number of material requests to the production floor, okay? And so we need to identify what's the best cause and effect. Number one, what are the most relevant cost drivers? Cost drivers being that activity level that most closely correlate to a cause and effect relationship to cost. And then second, how can we group certain costs and associate them with a specific cost driver? So what activity-based costing is getting us to is the use of multiple cost drivers and the subcategorization of overheads in such a way where that group of overheads behave in a certain way that correlate in a very strong way to that particular cost driver. I know that I've given you a lot of information. I hope you look at this video. I hope this video is helpful. If you have any, feel free to email me with any questions that you have regarding this video, and I'll be more than glad to answer them before the next class. Again, I sincerely apologize for being late. I swear to you, this is the first time in 9 years that I'm late to the point where students actually have to leave. But don't feel like you have to absorb everything that I've given you in this video, because that's something that we're going to focus on the rest of this course, and we're going to continue to repeat. And in your reflection, please give me your comments on the areas that you're struggling most with, because I definitely try to accommodate that during class. Thank you again.